Intraday trading, or day trading, involves buying and selling financial instruments within the same trading day. Unlike long-term investing, intraday traders aim to capitalize on short-term price movements. To succeed, traders need a well-defined strategy, discipline, and risk management. In this guide, we'll explore the best intraday trading strategies, key principles, and tips to maximize profits while minimizing risks. Understanding intraday trading means opening and closing positions before the market closes. Traders avoid overnight risks and rely on technical analysis, volume trends, and market momentum. Quick profits can be made by capitalizing on small price movements, and there is no overnight risk since positions are squared off the same day. Brokers offer higher margins for intraday trades, but there are challenges such as high volatility, emotional stress requiring quick decision-making, and increased transaction costs due to frequent trading. The best intraday trading strategies include momentum trading, which involves buying stocks that are moving strongly in one direction and exiting before the trend reverses. To use momentum trading, identify strong trends using indicators like moving averages, relative strength index, and MACD. Enter early by buying when the stock breaks resistance with high volume and exit smartly by booking profits before the momentum fades. For example, if stock X rises 3% in the first hour with high volume, buy and exit at a 5% gain. Breakout trading involves looking for stocks breaking key support or resistance levels, expecting a strong move. To trade breakouts, identify consolidation in stocks trading in a tight range. Watch for volume since breakouts with high volume are more reliable, and set a stop loss below the breakout point to limit losses. For example, if stock Y has been trading between RS 100 RS 105 for days and breaks RS 106 with high volume, go long. Pullback trading, or the retracement strategy, involves entering a trade when a stock retraces temporarily before continuing its trend. To trade pullbacks, identify the trend using trend lines or moving averages, wait for a dip to buy when the stock pulls back to support, and confirm with indicators like RSI suggesting a good entry. For example, if stock Z is in an uptrend and drops to its 20-day MA, buy expecting a bounce. Scalping involves making multiple small trades to capture tiny price changes. To scalp, use tight spreads by trading highly liquid stocks. Aim for small targets of 0.5% to 1% gains per trade, and ensure high volume for quick execution. For example, buying 1,000 shares of a liquid stock at Rs 50 and selling at Rs 50/50 repeatedly. Moving average crossover strategy uses two moving averages to generate buy-sell signals. The golden cross occurs when the 5 MA crosses above the 20 MA, indicating a buy, while the death cross occurs when the 5 MA crosses below the 20 MA, indicating a sell. For example, if Nifty's 5 MA crosses above 20 MA at 9:45 a.m., go long. Gap trading involves trading stocks that open significantly higher or lower than the previous close. There are types of gaps, such as breakaway gaps indicating strong trend continuation and exhaustion gaps signaling the end of a trend. To trade gaps, buy if the stock sustains above the gap after a gap up, and short if it stays below the gap after a gap down. For example, if stock A gaps up 5% at open and holds, buy with a stop at the gap level. Essential tools for intraday trading include technical indicators like RSI, MACD, and Bollinger Bands, which measure volatility and potential reversals. Candlestick patterns such as doji, hammer, and engulfing can signal potential reversals. Volume analysis is also crucial. Rising price with rising volume indicates a strong trend, while rising price with falling volume suggests a weak trend. Risk management in intraday trading involves using stop-loss orders religiously, setting a fixed percentage of capital at risk, and placing stop-loss orders below support or resistance levels. Position sizing is important. Risk only 1 to 2% of capital per trade and avoid over-leveraging. It's also essential to avoid overtrading by sticking to 3 to 5 high-probability trades per day and not chasing losses. The psychology of intraday trading requires discipline to follow your strategy strictly, patience to wait for the right setups, and emotional control to avoid letting fear or greed dictate trades. The best stocks for intraday trading are those with high liquidity, such as Reliance, HDFC Bank, and TCS, as well as those with high volatility like Yes Bank and Tata Motors. Sector leaders such as Infosys in IT and ICICI Bank in banking are also good options. Common mistakes to avoid include not using stop-loss orders leading to big losses, revenge trading which results from emotional decisions, and ignoring market trends by trading against the trend. In conclusion, intraday trading can be profitable with the right strategy, discipline, and risk management. Whether you prefer momentum trading, scalping, or breakout strategies, consistency is key. Master 1-2 strategies first. Always use stop loss, keep emotions in check, and trade with discipline. Start small, refine your approach, and gradually scale up. Happy trading! Would you like a more detailed breakdown of any specific strategy? Let me know in the comments.